All right, joining me to talk business is Carroll Penick. He's the Chief Operating Officer and Chief Lending Officer at Delta Trust and Bank. Carroll, thank you so much for being with us.
Thanks, Roby. I'm glad to be here.
Well, let's talk about what's at work in the current business environment, the current banking environment right now. We got low interest rates. We got banks flush with cash. Is it a borrower's market right now?
Yes, very much a borrower's market. If anyone has an existing loan that has any rates, I would even say above 5 or 6%, now's the time to go talk to your banker, because we need loans. And all banks have all this cash, and they'll do some deals that they've never done before.
Well, what's preventing people from, I guess, doing some of this? Do you have some customers that have some damaged credit from the recession and the recovery?
Yeah, I have to say you must be a qualified borrower, to say the least.
Define qualified.
Qualified to me means someone who has probably a lower debt-to-income ratio, a higher debt service coverage ratio. We bankers talk a lot of ratios, and then probably even on the collateral side, probably a low loan to value. If you have those three things, then now you can pretty much negotiate the best deal you've had in quite a while.
Give me an example, obviously without naming particular clients or anything, but give me an example of a kind of deal that you've had come up lately that kind of fits that description.
Oh, I'd say probably like a commercial real estate loan, say in Central Arkansas, where you have a 90% occupied piece of real estate, and you don't owe that much on it. Your loan to value, your loan compared to your collateral value is probably, say, an 80% range, and your debt service coverage is over a 1.1, 1.2. Those kind of deals, people will do a 15, 20-year amortization with a 5-year balloon. They'll fix rates. The banks will fix a rate from 5 to 6 years now, where they hadn't been doing that. And you can get some, Wall Street Journal Prime is 3.25 right now. If you're willing to float, you might be close to that rate, but then you'll probably have a cap of 6, 7, 8%, depending on your financial condition. But it is really the banks are refinancing each other's loans right now. I mean, as we all know, it's if I don't take care of my customers, they will go somewhere else and find
card shuffling going on.
Exactly.
So is that the bread and butter right now? I mean, what's really kind of generating the most transactions for you?
That is the bread and butter. I would say we'd love to do a lot of new customers, new businesses, help people get started, but people are still nervous about the economy. They're scared to go risk their capital to start something new. So what they're doing is, how can I save money? And usually can I get a lower interest rate on my existing loans? I think I told you earlier, I think we financed this year, we've closed over $70 million in loans, and our loan portfolio has only gone up $12 million because of other people going and finding deals that they refinance our loans. So it's kind of we're all just trading each other's loans is what's happening to us.
You mentioned the trepidation earlier, that there's a lot of caution out there, some conservatism out there. Why do you think that is? Is it obviously there's some presidential politics in play here, but what are you hearing actually people say?
I think it is the regulator. The regulators have gotten tighter on us to how they classify loans, that if you don't meet these minimum requirements to be a qualified borrower, then we shouldn't be making that loan. And so the bankers hear it loud and clear. When we go through a bank exam and they criticize a loan that we would never criticize because they've never missed a payment, they've never been past due, everything collateral seems to be okay. But if their debt service coverage is a little bit low, they had a tough year last year, then they're putting those loans, they're making you take a closer look, and they're saying, should you be making those kind of loans?
Well, that seems a little unfair to me. If you've got somebody that has that kind of track record and has been doing well, I mean, where's the incentive for surviving versus, clearing out, filing bankruptcy, getting rid of what they've done all, to unload all that stuff on you?
I'd have to agree with you that it's gotten to be where we feel like we're really being managed by the regulators. We have to make business decisions based upon how we're being regulated. And that's not totally fair sometimes to a borrower, because it used to be, as long as you had never been past due in the last year or two, it didn't matter basically what your financial condition had been. Your loan was still considered a quality loan.
Well, I think we're touching around a subject that I wanted to move to, and that's the Dodd-Frank legislation that went into effect a couple of years ago. It was the reaction to the Wall Street banking crisis. Right. How is it affecting your bank beyond just this regulator coming in and telling you how to make some of these loans? What are you having to pay more for now?
Well, really, I would say consultants. outside auditors coming and reviewing our files before the examiners come. In the past, we could have just an internal auditor look at different departments, different loans, but I know nowadays we have to hire outside accounting consultants to come in and look at our trust departments, look at our loans before the examiners get here, look at our compliance to make sure we're in compliant with every regulation. And that cost has driven us up. Really, I would just say that it seems like we are spending an awful lot of time getting ready for exams, and then the exam finally comes, and you spend 3 to 4 weeks with an exam.
So how does all of that trickle down to your bank customers? What are you having to, I guess, pass along to them to cover some of those expenses?
Well, you'll see things like what interest rates on all our deposits, CDs, money market accounts, those kind of things. You know, this is the lowest in my 30-year banking career. I've never seen us pay 1 basis point on an account. You know, that's unbelievable. And really, that's the depositors are taking the brunt of it because we're not paying very much on interest, but they're scared to go into the market or buy real estate or whatever, so they're keeping the banks flush with cash. But then we turn around and try to make loans. Well, all of our borrowers sit there and say, well, now is the time to refinance everything so we can get a better rate. So we're kind of caught in the middle here. But really, I would say the average retiree or someone on fixed income who depends on interest on CDs, they're the ones that are really paying the cost. Mm-hmm. We still have more auditors looking at all of our areas of our business than ever before.
So what unclogs all this? What's going to unravel some of this?
You know, to me, I think rates have to come up a little bit, and the economy, we need people to get back to work and have jobs, more taxpayers' money, because as long as this is going on, the Fed's going to keep rates low. I actually went to a seminar a week ago. An economist said to all of us bankers that we had 8 more years of this, and that scared all of us because we need rates to move up a little bit just so we can start making a little more money. We can take a little bit more risk on our loans, and everybody can be able to borrow money.
All right, thanks for being here. He is Carroll Penick. He's the Chief Operating Officer and Chief Lending Officer for Delta Trust and Bank. Thanks.
Thank you.